to another episode on market structure mastery. Now, previously, for like few months ago, we talked about market structure. We talked about how to identify valid break of structure, how to identify valid change of character, and many more like that. How to identify a weak trend and the likes. So, in this episode, we'll be talking about liquidity concept. Now, liquidity concept, and at the end of this liquidity concept goal, we should be able, to be able to mark out liquidity zones and how to set your take profit, also your targets. Areas you should watch out for and to avoid. So you should be able to understand where liquidity is. First of all, what is liquidity? Liquidity simply means money. So if you see any video, watch, read any, document or PDFs that talks about trading, just know that liquidity just simply means money. And how is this liquidity? How does it simply means money? Now, very simple and very understandable. Now we'll start from understanding liquidity. Like I said, liquidity simply means money. So you as a trader, your stop loss, your take profit, your entry, your orders that have not been executed are liquidity. Do you understand? They are liquidity. Now, think of it this way. We have several traders. Trader A, right, trader A bought gold, for instance. Trader B sold gold, for instance. Now, let's, for instance, in same chart, where market is going upward. Don't forget I taught you about break of structure. Market is going upward, right? Now the first trader who first of all bought, that's trader A that bought, right? For instance, he bought around right here, right? He bought around right here. Now trader B that sold around this area also. Now for trader A stop loss, where will his stop loss be? The stop loss will be right there, which means if trader A bought, right, is expecting market to go up and not market should come down in it. Now, but if trader B sell, is expecting market to come down and not to go up. Now, trader A who bought, right, who bought this place, this low is a stop loss, this place is a take profit. Trader B who sold, this place is a stop loss, then lower low would be is what? Take profit, right? Now, as a trader, right, for you to understand liquidity, you must know where entries are being placed. Now, the both of them take same sell, same buy, same entry, same level, same zone. They bought, one sold. Now, eventually, market pushed up and goes up. It means trader B who sold, his stop loss will be taken away. Now, his stop loss that is right here, now is trader B take profit, which simply means that trader B's money has been donated to the market for trader A to earn in the forex chart. Are we getting that? Now, if peradventure market, right, then did not follow trader A's concept, rather it sold, it means trader A's stop loss, which is right here, has been taken away, which simply means it has given trader A loss. Trader B has made money from that loss. Trader A has donated his money into the forex chart. Simple as that. So when you see trader bought and you see trader sell, just know that one of them is the liquidity, depending on where they've bought. Now, there are areas, zones at which we identify where liquidity is. Now, question one, which you should be thinking of, is how do we now identify all of this liquidity? Let's go into the chart. To identify a change, sorry, a liquidity, just simply what you need is to understand retail entries and retail strategy. Simple as that. Now, remember very well, if you are trading trend lines, support and resistance, you are trading double bottoms or chart pattern as a whole, you can serve as the liquidity. Now, note something. Those trading trend lines, those trading double bottom chart patterns and the likes, I am not saying that they are not a trader. They find their way around to take profit faster than waiting as the smart traders would wait for liquidities to be taken out. Now, how do you identify liquidities on the chart? Very simple. Now, when market is going bullish, right? I'm going to explain what a trend line is. I'm going to explain what is resistance and supply is, so you can understand what I am talking about once more. Now let's go into trend line. What is a trend line? A trend and the line on that trend. Simple. It is two words that are joined together. Trend and a line joined together. Now, when market is going higher highs, higher lows, that is trending, right? Now, when you connect a line together with it, you've connected a trend line. When market is dropping lower lows, lower highs, when you connect a line together, they've connected a trend line. They will get that now. So you must remember this. So when you can identify a trend line on a particular movement, market is going up or like this, then this is what? Trend line, which simply means they are what? They are money, right? They are money. And how is it money? Simple as a basic. How is this trend line a liquidity? Very simple. Now, once retail traders sees, once retail traders sees that market pushed up, comes, pushed up, comes, pushed up. Now they mark out first, second, third line. Now the next movement is they will wait for market to come back before they buy. That is their plan. That is their goal. That is their intention. Do you understand? To come back into that line, this is the first touch. Let's change the color. This is the first touch, second touch, third touch. Now on the fourth touch, what would happen? They want to take their buy. Do you understand? And if they're going to take their buy, where will their stop loss be? Just below this low. Where will their take profit is? Just above this high. Do you understand? And what will market do? Because it is trend line. Because they are retail traders. Because they did not know what liquidity entails. Now they will just jump into the buy after some confirmations, after some aggressive entries on impatient, everything. They just jump into the buy. They jump into the buy, market turns away, change character right there. And don't forget what I call the change of character. The change of character is when market disengage in the previous movement. We have break of structure, break of structure, break of structure. Then rather we should have another higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. Right? Then we should have higher lows. But what market did was take out the low and caused another lower low, which means we have a change of character. Right? So what does a change of character, how does it affect comes here too? So when market comes into this, right, and then we mark this point as the low. As soon as market created this, and then buyers are buying from this point, but immediately market disengage from going up, means we have a change of character. So therefore, all of these liquidities are what? All of these trend lines are what? Liquidities. Do you understand? So they are liquidities. We symbolize it as what? Dollar sign, because it is money, right? Stop losses, stop losses, stop losses, and many more stop losses till the last breath. They will get that. So that is how liquidity as a trend line works. So we have several types of liquidity. We have liquidity as a trend line. We have liquidity as a trend line, right? Trend line liquidity, uh, trend line liquidity. We have the double bottom or chart patterns, right? We have the chart patterns. We have the chart patterns, right? We have what? The ranging market, ranging market. This is the basic knowledge of liquidity. Now, once we get into the advanced knowledge, we will split it into different forms, which would make you understand very well. Right, we have the inducement liquidity. I'm going to short it as IDM liquidity. Also, so you must always remember all of this, because these are very, very important. So, as basic or beginner who is just getting into smart money concept, you must remember all of these things properly, that liquidities are seen in trend lines, in chart patterns like double bottom, double top, rising wedge, rising falling wedge, triangular, whatever line you get, and also ranging and inducement. Now, I've explained trend line, then chart patterns. What? How do you identify a liquidity chart pattern? Very simple. Most liquidity chart pattern is what? Most liquidity chart pattern are double top and double bottom. People get that. Most liquidity chart patterns are what? Double top, double top, and double bottom. Right, and double bottom. That's it. Double top and double bottom. So now, how do you identify this chart pattern? Market moved from one resistance down to this support. Now, market came back, moving to that resistance, giving it equal highs. Now, as a retail trader, what you will do is what? You take the sell. And how do you now measure your take profit? You measure from this neckline to this double bottom. Then your take profit will be from after this low has been broken, and then you will sell further. That is trend line. That is double top. Double bottom, WA pattern. Market comes from the resistance to the bottom, and then comes to tap or test that support again, right? And then pushed up. Now, as a retail trader, what do you do? After it has broken this neckline, you measure this neckline, you measure the neckline, then for your take profit, you buy when market retests, right? And use this measurement as your take profit on it after the neckline, right? That is how retail traders stick. But according to liquidity, where does the liquidity forms? Simple as ABC. Where does the liquidity forms? Now, this is it. When you have a double top, right? Now, because of, I know that traders will be interested to sell immediately market breaks right here. Market makers know you are ready to sell. Big boys in the forex chart knows you are ready to sell. What do? They take you out first. After the neckline, they take you out first, clearing out this top or double top to come back to deliver. Then those that are selling, setting their stop loss right here, will be taken away. That is, their stop loss has been what? Has been generated. Now remember this very well, that liquidity serves as what? Fuel. right? Liquidity serves as what? Fuel. So it makes the market to move smoothly. It makes the market to move what? Smoothly. So if liquidity is not taken out, or liquidity has not been taken, I mean the market doesn't want to move. Market will now keep on generating much more liquidity, letting fake buyers, letting fake sellers into the market. Do you get that? So you have to wait for liquidity to be taken out. We are going to get there. Just be able to identify where liquidity is. Now, you remember the market after double top, market will come back to take out that liquidity before it pushed up. Now, if it is double bottom also, market will come back to take out that liquidity before it pushed up, right? Remember this very well. So no matter what, you have to, whenever you've seen a double top or double bottom, just stay away from that level for entry. Just wait for market to take it away before you make any decision. Is that clear? So what next is what? Let's talk about the we'll talk about the inducement liquidity. So before we talk about the inducement liquidity, we'll talk about the ranging market liquidity. Now, what does the ranging market liquidity talks about? It talks about when market moves from resistance to support. I want to believe you know what resistance and support is. If you do not know, go back to my video and watch. But I am going to just brief it again inside this video. So a resistance, right, and a support is just like this. So when market is going bullish, right, what makes this point to pull back first? It means it got to a resistance level first, and then that resistance push it away. So just imagine that you want to go through first level, second level, third level, and then the higher the level, the more difficulty it is. Are you getting it? This is how the trending market works. So the higher the level, the more difficulty it is. So once it moves from this zero level to this level, it gets into another difficulty. Market did what? Market pushed it back again, right, to generate more power so that it can break that resistance. So now, when market got into this level, what made this market to move? It is the support. They call it support, right? It is the support level. So market from resistance returned the market price and then gave it more power to break that resistance. Now, this is how support and resistance works. But now in a scenario whereby we have market ranging, it means market move from resistance to from support. This is support, this is resistance. Now market move from support to resistance, and from resistance to support, and from support to resistance, and from resistance to support. Now there is no breaking to the upside or downside. Are we getting that? Now, unlike when market is trending, right, we have break of structure, break of structure. Or when market is going bearish, we have break of structure, break of structure. But right here, we do not have any break of structure to the upside or to the downside. So market is consolidating, going sideways and ranging. Do you get that? Now, in this scenario, what do you want to do as a trader? As a smart money trader? Once we've identified market ranging like this, right? Want to sweep market sweep and then begins to sell, or market sweep to the downside first, excuse me, or market sweep to the downside first, begins to buy. Do you understand? This is how liquidity. So market takes out every buyer right here, and then comes back to what? Buy again. So those that are buying right there, market take them away. Those that are buying when market has broken it to resell, market takes them away and before it buys. That is how support and resistance or ranging market liquidity works. Now we're going to check into the chart before we talk about inducement in another video. This would be the first part of the liquidity concept. The second part of the liquidity concept will be dropped also. So let's check those explanation and how market has treated those trend line, chart patterns, and ranging market. Let's go into the chart. All right, let's start from trendline liquidity. A trendline liquidity, like I said, market has to, you have to be able to align it together. Look at this example that I made right here. Right, what happened? First touch, second touch, third touch. Now, as a trader would trace trend line, right, what will you be interested in? You will be interested in taking a sell from the third touch right here, from this level right here. So it means market drop from that level, pushed up, drop again at the break of structure, pushed up third level, drop at the break of structure. That is when market is testing, we should be selling, right? But look, as an SMC trader, which you've already marked out all your zones perfectly, because I'm still going to teach you inducement. This is our inducement. Market already take out inducement and then broke, gave us a valid break of structure right here. So which simply means that what we should be expecting market to come back into our zone before we take our buy. So as you can see that this is our trend line, right? Traders that are not looking into that will be looking for a sell from right here, right? And what happens? Immediately market taps into that level, market breaks through and give us a change of character to clear all of this trend, and then you can see what market has done. Market eventually bought and went bullish, taking out those eye away. Look at it. This is it. Taking out these eyes away. And then eventually market did what? Market did it. Alright. This is a typical example of trend line liquidity. Do we get that? That is a typical example of trend line liquidity. Right. This is trend line because you want to take a sell. Traders that are selling will be taking a sell first touch right here, second touch right here, third touch right here, then planning to take another fourth touch to sell. Do you see that, right? That is how the trend line works. And also, if you look into this point as well, market also give another trend line here, trend line right here. We have several touch. So what market did was what? Take out all of those trend line, then before it pushed up, right? Because it has to follow the normal structure and the higher time frame structure, which I have told you and I've thought about. If you've not checked it, go through my video, go through my channel. You will see where I talked about market structure, swing highs and swing lows, etc. To understand, that is how you identify a what? A trendline liquidity. Now, how do you identify a double top and double bottom? Let's check through and see how we identify a double top and double bottom. So this is an example of double top which market came back to take away. So this is an example of double top, and then market did what? Market came back, grabbed the double top away, right, right, and then came back to deliver. So as a trader, I will teach you in the next video how to execute a trade perfectly after when liquidity are taken out. So the double top was taken out by this, right, and then market came back to clear out the low, right, and then you can go into your chart to look for more uh double top, double bottom, and then trend line liquidity. Now let's talk about the ranging market, right? How market has ranged for a while before market now breaks above to take out liquidity. Let's go into gold. Let's go into gold. So on gold, there was a point at which I come across that ranging market for a while, then before market breaks it above. Okay, let's check very well. All right, so around here we have this ranging market right here. Market is moving so ranging right here, and then what did market did? Market came back. Excuse me. Market came back, taking out the low, sweeping out liquidity. Therefore, how is it a liquidity? Those that are um trading retail strategy, break and retest, would take a sell right here, set their stop loss right here, and don't forget what I call liquidity. Right, take a sell right here. Sorry, undo. Don't forget what I call liquidity. Liquidity is what? Money. Where your stop loss, take profit up in place. right? And don't forget that while this seller is taking a sell right here, right, some people are already taking their sell right here also. Some people are already taking their sell right here also. Those retail traders, right, taking their sell right there because it has already rejected from what do you call the resistance level. So to target only God knows, perhaps this low, right, and also all of this low too. But as a retail trader, as a smart trader, we should already know that after ranging market, you need market to see take out liquidity. So market first of all break below, taking out this liquidity, then you take your buy. Right now, they didn't just induce only sellers; they induce buyers too, who think they are smart, but they are not smart. Now, buyers that are also buying from right here, from this ranging market right here, they liquidate them because where will be their stop loss? Their stop loss will be right below this low right here, setting their stop loss right here. So, how many sellers? How many traders did they induce? They induce three types of traders. Those are early sellers, late sellers, and early buyers. You understand? But if you use the smart money concept and understand the liquidity, you would wait for liquidity to be taken away before you do what? Before you execute your trade. And then immediately market takes out liquidity. You can see what happens. Market takes out liquidity and then market pushed above. Right? This is uh, a typical example of what? Ranging market. So if you do not really understand and you have some question, you can hit me up in the comment. Also send me a DM on my WhatsApp. My WhatsApp number would be displayed in the description box, and my Telegram handle will be displayed on the description box. So send me a DM if you have series of questions and you want to learn more about it. See you guys in the next video. Bye.